So in the case of a chargeable gain, sometime it happens that we sell some part of the assets. For example, in the case of land, for example, if part of the land has been disposed of, then the issue is that how to allocate the cost of the total land among the part disposed of. So for that, we have to use a formula in order to allocate the cost to the part disposal. And then formula is cost original cost, that is the purchase cost and the incidental cost, multiply by a upon a plus b. So in this calculation, a reflects the gross consideration of the part disposed of, that is the gross value, and b represents the market value of the remainder land. So for example, 10 acres of land has been purchased at a cost of 50,000, and then 4 acres of land has been sold at a price of 38,000, market value of the remaining 70,000. Calculate gain on disposal. So first of all, what you have to do is to find out the allocated cost of to the 4 acres of land. So we have applied cost into a upon a plus b. So cost was 50,000, a was 38,000, and then a plus b. So this gives us a result of the allocated cost of 17592. Now we have find out that the sale proceed of the 4 acres of land was 38,000, the allocated cost 17592, and the gain that is to be charged in this year is 20408. Now the remaining cost is to be attributed to the remaining part that we have to use when the remaining part is subsequently disposed of. So when we will dispose of the remaining part, we will calculate the uh, gain of this part. Now another rule is the small part disposal. It covers in the part disposal calculation. So obviously it's related to land and building. So when proceed received from the disposal of part is small, then a part disposal gain or loss arises. The normal gain or loss that we calculate, unless now you have an option that an election can be made, and if you elect for that, then the effect of the election is that there will be no part disposal. No part disposal. What it means? It means that you get a type of exemption that you don't need to pay any tax on this part disposal, and the gain is to be deferred until the disposal of the remaining part. So it's a relief of the timing, that you can get timing relief, and the gain is deferred. What you have to do, the proceed on the small disposal is to be deducted from the original cost of the asset. So this is the concept of the base cost, and the cost will be reduced, and subsequently there will be a high gain. So we will get a base cost, and then this base cost is to be used for the calculation of the subsequent disposal. Now, what is the definition of a small part disposal? So in order to consider that, proceed of the part disposal, that is the sale proceed of that disposal, two conditions must be satisfied. Either it is less than 20% of the value of asset before part disposal. So it means that the sale proceed, if the sale proceed of the part disposal is less than 20% of the combined value, then you can say that this is considered to be a small part disposal. Or you can say that the total of all land sales in the tax year is less than 20,000. So in a particular tax year, if the sale proceed is less than 20,000, then we can say that this is considered to be a small disposal. Now let's see the question. For example, uh, we have purchased 12 acres of land at a cost of 30,000 in March 2009. Then subsequently 2 acres of land has been sold for 9,500 and the remaining 10 acres of land worth 80,000. And then subsequently September 2019, the remaining land was sold at a price of 1,35,000. Calculate chargeable gain arising on disposal if no election was made regarding small disposal and an election was made regarding small disposal. So when no election was made, that means we are not interested in small disposal calculation. So in this case, first of all, we have to identify the sale proceed of 2 acres of land that has been given in the question, that is 9,500. Then we need the cost of that 2 acres of land, and for which we have to work out the cost, and for which I have used the formula, that is cost into A upon A plus B. So as far as this is concerned, the original cost was 30,000. The part disposed of value is 9,500. The remaining value is 80,000. So 9,500 plus 80,000. This will give you an answer of 3184. So deduct 3184 from this value will give you a gain of 6316. Now, the again the disposal for the next disposal, the remaining. So sale proceed has been given as 1,35,000 of the subsequent disposal. The leftover cost is 30,000 minus 3184. That becomes 26816, and the gain is 108184, and this is the gain on the subsequent disposal. Now let's move ahead with if there is an election for deferral has been made, then in case of election, first of all we have to check that what is the situation. So the whole 12 acres worth we have to identify worth, and that is 9,500 plus the remaining 80,000. So the total worth is 89,500. And this is the only land that has been sold in this year. So the sale proceed received are 9,500. Now we have to check the rule. Rule number 1 says that the 20% value of the total proceed, and that becomes 17,900, as it is as per the criteria. We have checked the criteria is proceed of the part disposal is less than 20% of the value of asset before part disposal. So, and total of all lands in sales will be less than 20,000. So our criteria is our sales value is 9,500, and this 9,500 is less than 17,900. So the criteria has been satisfied. and this 9,500 is also less than 20,000. So both the criteria have been satisfied. Therefore, an election can be made. So that means no gain on part disposal. Now, the gain will arise on the subsequent disposal, and when you will subsequently dispose of, you have to identify the base cost. How we can identify the base cost? Our original cost was 30,000. The sale proceed of the part disposed of is 9,500. Deduct this from, so find out the base cost, and that base cost becomes 20500. Now, on the disposal, subsequent disposal, you have to identify the selling proceed, that is 1,35,000, and the base cost. Deduct this base cost from this, and this is 20500. So you will get a figure of 114,500, the chargeable gain. Now let's talk about the treatment of chattels, very important thing for the exam. So we can define the chattel as those assets which are tangible in nature and movable property. So those assets which are tangible, having physical substance, and which can be movable are considered as chattels. So you can say that building cannot be classified as chattels. Plant can be classified sometimes as chattels. Car can be classified as chattels, but car is not is exempt for CGT purpose. So following examples you can use: table, jewelry, paintings, boat, horses, and so on. You can classify chattels as into two classification. One is the vesting chattels, another is non-vesting chattels. So you can classify vesting chattels as those assets having life of 50 or less, and if the life is greater than 50 years, then those chattels are considered as non-vesting chattels. As far as the vesting chattels are concerned, that vesting chattels are always an exempt asset, except for there are a few exceptions. There are exemption, an exception that deals with sometimes vesting chattels is taxable. So in general, if a chattel is a vesting one, it will be a exempt one. Now, as far as the non-vesting chattels are concerned, having life of 50 or more, there are two rules. One is if selling price and cost is less than equal to 6,000, that chattel is an exempt one. So it's a non-vesting exempt chattel. And if selling price is greater than 6,000 as well as cost is greater than 6,000, then you have to apply the normal CGT calculation. Other aspects are not examinable in this ATX exam. For example, if selling price is greater than 6,000 and cost is less than 6,000, such thing is not examinable. You can see that, for example, say suppose the selling price is 20,000 and the cost is also 14,000. So this is the case of a normal calculation, and the gain is a normal calculation. So this is applicable to be a normal calculation. Now, as far as the vesting assets are concerned, so we can classify them as chattels not eligible for capital allowances. For example, these are not be a part of plant and machinery definition. Chattels eligible for capital allowances, and other vesting assets which are not considered as a chattel. So for example, those chattels which are not eligible for capital allowances and are vesting assets, they are exempt. No calculation is required. But as far as those chattels which are eligible for capital allowances, such as plant and machinery, then you have to see that whether they have been sold at a gain. If this is the case, that a vesting chattel considered as plant and machinery sold at a gain, then there will be a normal calculation. And if a vesting chattel eligible for capital allowances sold at a loss, then there will be no gain or loss, as it is already covered in the capital allowances calculation. So we can simply write no gain or loss. Now, as far as the other assets are concerned, these other assets, if we talk about the other assets, these are non-chattels, so such as copyrights or intangible assets mostly. So what you have to do that normally these assets are depreciating over their life. So first of all, we have to identify how much is the cost related to the assets, that is an allowable cost. So in order to calculate the allowable cost, I'll use a formula, that is the original cost, and from the original cost we will deduct this one, that is p refers to the period of ownership, L refers to the life, total estimated life, R refers to the scrap value. So from the cost we will deduct the vested amount of asset, and then you'll get the allocated cost. So let's see from an example. For example, the cost of the asset was 45,000 on 16th March 2011. His life was originally 25 years. Scrap value was 60,000, and then asset was sold at 17th of March 2019. So it has been sold after a use of 8 years. So we'll use the formula. The original cost was 45,000. Vested cost is 8, that is life that is used, original life 25. 45,000 is the cost minus scrap value. So this is the depreciable amount into the amount of life used divided by the total life. This is the vested cost. So the total cost is 45,000. Vested cost is 12480. The remaining cost is 32,520. So we have to deduct selling price 34,000 and the vested cost, the allocated cost. You can say that the allocated portion 32,520, and this will be a gain. So in the case of the vesting asset, that is not chattels and other than chattel, so we can say that you have to apply the formula or convert your cost into the allocated cost. So whatever is the vested cost is to be deducted as per the formula, and that is P upon L into cost minus R, and then you will able to get the figure.